All right, guys, jokes aside, we do all the workshops. Obviously, none of this is financial advice and everything is for education purposes only. The goal of this is to explore DeFi, figure out what we can do and what we can't do, and how to do stuff responsibly, understanding what's going on, what is possible, what is dangerous, and get everyone to a place where we can all make our own decisions. You guys already know that, but I gotta say it. Welcome to Purple also. Amazing to have you. Thank you for doing this with us. Yeah, take it away, dude.
Thanks for having me. I'm sharing my screen. So if you guys want to look at the presentation, be sure to click on that. But today we're talking about yield farming and let's dive right in. First of all, who am I and why are we talking about this, right? I'm in crypto since 2021. And a lot of people have known me from the Sappy Seals community, including GVan and Moondweller, and a lot of people here. And I basically went from 0 to 6 figures in crypto in basically under 4 years. And during that time, I've been freelancing art, trading, investing, and doing DeFi farming. And the reason why I focus a lot more on liquidity pool yield farming now, because I found that it's the most profitable thing for me so far. I'm an artist. I am an entrepreneur. I've started a few businesses before in the past, and I'm also a degen. I like to buy NFTs and sometimes, gamble on like lower cap tokens.
I feel like I saw you, Richard, transitioning more and more towards DeFi farming, like slowly in a sense, right? I remember when you started posting more about it, and I feel like it's been like a couple of years since you started getting more and more into it.
I was like, hey, let me dive deeper into this, right? And
Yeah, and
that's,
also I think you did Blast, right? Back in the day. I think Blast
yeah,
was like a DeFi workshop for most of us, even though
yeah,
it failed horribly. It was
yeah.
like we got to try out stuff.
Yeah, for sure. I mean, I was providing liquidity for stuff like ETH and USDC on Thruster and actually had a pretty nice airdrop from that. But, back then compared to what I know now, it's like a world of difference, right?
I know what you're talking about.
Yeah.
Like I've seen the tweets and I've seen your YouTube channel. You leveled up massively since then. I'm not gonna lie to you. Like for me, like I got all that and I was like, okay, I get it. I get enough, but I'm doing stuff on Matera, but I'm not doing too much. And also I have a feeling I'm more on the degen side of yield farming rather than on the safe side. So I'm very curious to figure out, how to do stuff properly.
Yeah. I mean, like I would consider my portfolio to be like medium to high risk too. And I'll show you guys in a sec my portfolio. But I do have clients that are like yield farming mainly with like larger caps, stuff like, Ethereum, USDC, or Ethereum and Bitcoin, right? So let's dive right back into the slide. And this presentation is mainly for like people that are starting with yield farming or you've been yield farming a little bit. Some of this might be like a little bit too basic for you, but it's just a nice overview of yield farming. People who want to make passive income, who want to get to financial freedom. And I'll show you guys like the simple formula that you could use to calculate that number. And then it's also for longer term investors and if you're a trader. So if you're like a swing trader or a cycle trader, yield farming is actually a great tool to like supplement your income or to actually execute that trade. But who is this presentation not for? Yield farming, it's not going to like make you a millionaire overnight. You might get lucky like trading some memes that could make you a lot of gains, but basically yield farming typically is not going to like make that kind of gains, right? And if you're chasing those high APR gains, then you might as well just be trading like lower cap gains because your risk is much more limited compared to like, putting like half of your portfolio in like a degen sub 100 million market cap token, right? And if you're not open-minded or willing to learn, then obviously like we're just wasting time here, right? So let's dive right in on what we're going to be talking about. I will show you guys how I'm earning 25 to 75% APR on my capital using DeFi and basically safely doing it. How to achieve financial freedom using DeFi, example process of deploying a liquidity pool position, a few big mistakes that people make in yield farming, as well as how you could learn more about DeFi and then we'll go over like the questions you guys have at the end. So if we take a quick look at my current portfolio, and the reason why I show this is like some people think it's like a scam, right? Or like it's not profitable to yield farm, but I'll show you guys like it's pretty profitable for me. So you can see some trackers like shows a negative profit and loss, and I'll explain why. Sometimes this is not accurate, but the number I want you guys to see is like the earnings on my open positions, 11,000 something dollars, right? And this versus holding number is very important because it shows you that I'm beating impermanent loss and I'm doing better than just simply holding my tokens in the market. For example, ETH and Bonk. Bonk has been doing well recently, and compared to holding, I'm up roughly $300. All the meanwhile, I'm earning like 90% APR on my capital. So Bonk, I would consider a safer, a larger cap token, but obviously not as safe as something like Sol to Ethereum. And then you can see my portfolio like ETH and Pixel, this one that has been in range for quite a long time since November 26th last year.
Off, but I got a comment here. Like I've been holding on my Pixel for 3 years now without, and every day I wake up and I'm like, I'm still in the same range.
Yeah.
It's wild.
It's pretty wild. And same thing with Ethereum, right? I'll show you guys actually a yield farming position, a guy deposited in like 2021. And it's wild that Ethereum is trading below his entry. So it's pretty wild. And I guess if you're
it's like these realizations, unfortunately, they come to you after holding for a long time and being like, well, yeah, just holding is not good enough. Like I feel like crypto, like the main thing, like the main point that you gotta understand, like and have it imprinted in your brain is like you gotta put your money to work. Like you have that opportunity, you just gotta do that. Like you cannot have this capital just sitting there doing nothing.
Yeah, for sure. I mean, like if you're trading, for example, if you took a lot of profit, I also took profit when Ethereum was like trading above $3,000, and then you buy back in, right? That's a better use of your capital. But if you're holding for like 10K or like 20K Ethereum, then like you might as well put it to work in the process, right? I guess that's a tracker right now. And I wanted to show you guys another tracker. So here, an example of like an inaccurate tracking is when I deposited this Sol to ETH token, the US dollar value was higher in February 27th. I invested mainly Ethereum into this pool. So I swapped to Sol, right, to pair it into this pool. But because both Ethereum and Sol has kind of retraced in price, it doesn't mean I've realized like 5,000 something dollars worth of loss, right? It just means that during the deposit time, I would have been better stabling up compared to just holding these tokens. But at the same time, if you guys look at like the February chart, I wasn't going to sell my Ethereum at that level. So it doesn't matter, right? But you can see clearly here, Sol to Ethereum is trading in profit, is trading above my entry. So, depending on which assets you're bullish on, that's typically the asset you want to track, right? If I'm investing mainly with Ethereum, I'm yield farming with Ethereum, then I'm going to measure my profit and loss in Ethereum terms. And then I might shift to a US dollar basis once like the market overheats, right? Once Ethereum is trading at a high level, then I'm going to realize a lot of these Ethereum gains into US dollar. But you can see pretty decent profit on my open position, roughly 8.6 Ethereum right now. And my closed position totals up to like 7.7. And like I said before, sometimes I do make losses on these higher risk plays, but I do make pretty decent gains on like Pendle and ETH, Pepe and ETH, pools like that. So that's the portfolio so far. And just in the chat really quickly here, just so I could help you guys better, I want to know like what stage you guys are at. If you're unaware, it's like meaning you don't even know what liquidity pools are, right? And what is yield farming. But if you're aware already, if you know what liquidity pool is, you know how it works, but maybe you haven't started yield farming, right? Or if you're dabbling right now if you only have like less than 10% of your capital in yield farming pools, then you're probably still dabbling, or maybe you've been yield farming pretty extensively in the past couple months or years, but you're struggling, right? You're making a lot of losses and you don't have a process in place, then you might be at stage 4, right? And then stage 5, mastery. And mastery is not a fixed target, right? You constantly get better. But if you're there, then this presentation might be more basic for you, but hopefully you also get something out of it.
One thing here, just a bit more, just a question. Is there anyone in the chat that doesn't know what a liquidity pool is being used for? I don't think there will be anyone, but
I was gonna say this. If you don't know, it's fine. Like asking this is the right moment.
yeah, someone who doesn't know what liquidity pools provide to crypto.
Yeah, I guess a little bit of people don't know, but we'll go over it like really quickly for that portion because I think a lot of people are in like stage 2 or stage 3, right? They're aware that they're dabbling, but they haven't like kind of scaled up their portfolio, right? My current crypto portfolio, I have like more than 50% in liquidity pools right now. So that's when like I've put my capital to work because it's the most profitable thing for me right now, right? So there's 3 main ways to earn from DeFi. There's stuff like lending, staking, and you could do like leverage lending too to gain like a higher APR, but there's like risk associated with that as well, right? Every strategy has a risk, including concentrated liquidity pools. And I was saying, if you want to play it safer, you could expect roughly 25 to 75% APR on most pools. And these higher APR pools typically come from like higher risk, lower cap tokens, like for example, the AI XBT token that I just got into, right? But yeah, every strategy comes with its own risk and including concentrated liquidity pools. But before we begin, I think it's important to start with like an end in mind. And Jivan kind of like tweeted this already. But some people were also asking, how much do I need to generate like $4,000 a month? Like $3,000 a month or $5,000 a month. This is the number you need, right? Your annual expense divided by the APR equals your freedom number. So your freedom number is the amount of crypto that you need to maintain in liquidity pools to be able to like sustain that your annual expenses, right? To cover your annual expense. For example, for me, my annual expense is roughly like $30,000 per year. And if I'm able to generate 50% APR on my portfolio, then I only need $60,000 yield farming to cover my expenses. And if you use a more conservative number, and I encourage a lot of people to do that, you want to set like higher targets for yourself. You could even use 3%. That's usually like the number people use for traditional retirement investments, like 3 to 4%. But let's say you use 10%, then I need like $300,000, right? If it's 3%, then I would need $1 million to be able to live off of my passive income. And when your passive income is greater than like your annual expense, it means you're financially free and you don't have to work another day in your life if you don't want to, right? And it is possible to achieve this long term, even if you have very little capital, as long as you're willing to invest and let your wealth compound over time, right? And I've been able to basically use this strategy to grow my wealth over time. So if you guys look at this, you could Google like compound investment calculator. This is just a simple compound interest calculator, right? For example, if your investment time horizon is 15 years for crypto and you're able to save like $1,000 per month to invest and you started out with 0, right? And then in 15 years, you're earning 25% per year on your capital. And it depends on how good you're doing with yield farming and how much crypto appreciate. But for example, if you measure like the low to low of my portfolio from last year to this year, I've gained roughly like 60, 70% return on my capital. So it varies year to year. If you're in like a bull market, it might be higher, right? And it might be lower when we see such a like big market retrace like we saw in these couple of months, right? But basically, if you are able to grow that pie by 25% per year, then you're going to end up with like $1.3 million in 15 years, right? And as we talked about, let's say like you have $1.3 million earning 10% APR, then you're able to basically generate like $130,000 before taxes to pay for expenses or to make other investments, right? And for me personally, I mean, you want to run like your own numbers to make sure that it's suited to your own goal, right? You don't want to just use my number. If you Google like Dave Ramsey investment calculator, 1 second, then it should come up. But basically my own personal portfolio, if I don't contribute another dollar into it, then I'm going to be able to have $2.7 million worth of crypto like 15 years from now. And 15 years seems like a lifetime in crypto terms, right? But to be able to like be a millionaire in like 15 years through crypto is not too bad to me, right? Especially if you don't have a big portfolio yet, you want to kind of zoom out and look at the big picture here. So that's pretty much it. You want to set your own targets depending on what annual expense you have that you're comfortable basically sustaining over time. And so the next thing I want to share is like, I want to draw like a few parallels and differences between like yield farming and trading. So at the end of the day, you're trying to make money with these tools, right? And when you're trading, it's more similar to hunting. You're waiting for like different setups. You're looking at the charts, right? And then when you execute a trade, like you kind of go in for the kill, right? And then after you killed and got like that target and then got your profit, then you have to like hunt for another setup. You can't just make one successful trade and then like call it a day and you're a millionaire and you keep making money from that, right? It takes like a continuous effort. And similarly with yield farming, like it's in the name, right? It's similar to farming where like you're planting the seeds. You got to look after your crops. So there is some work to be done, right? It's not completely passive. You still need to keep up with the charts and, look after your investments. But it's more like a sustained and passive thing when comparing to like trading, for example, right? Especially day trading, which could be like much more time consuming than like a swing trading strategy, right? But for yield farming, I typically take only like 1 to 2 hours per month to manage like 5 to 10 positions, and which is not a lot at all if I'm not looking for any new investments, right? Yep.
1 to 2 hours per month? That's it?
Yeah, that's it. Like people run like super complex strategies, but once you have like a process in place, like different spreadsheets in place, then it becomes like very easy and effective to manage, right?
That's crazy, dude. That is
Yeah.
crazy. I'm definitely over
But you
my
keep an eye daily on charts, right?
Yeah, I like to look at charts. You don't have to because like with yield farming, you could simply just look at like the daily and the weekly chart and just chill. And if you
Yeah.
have those tokens in the tracker, you don't really have to look at them daily. Yeah.
Awesome.
Yeah. But that's basically the main difference between yield farming and trading. And for those people that don't know what a liquidity pool is basically when you're trading token from a decentralized exchange like Uniswap or Radium, token has to come from somewhere, right? And these tokens come from liquidity providers like myself, or if you guys are providing liquidity, we deposit these tokens into that DEX, like Ethereum, Solana, USDC, whichever token you're providing liquidity for, Fartcoin, hot air rises. But when basically the traders make swaps, you're basically swapping, for example, your Solana for Fartcoin. And then in that process, you're getting charged a fee, right? And these DEXs typically like pass down the fee to the liquidity providers. And that's where I make my money, right? And that's simply how that works. Why concentrated liquidity pools? So there's like two main types of pools. One is like a flatter V2 Uniswap pool where the liquidity is spread out from like 0 to infinity. And the other is the V3, V4 pool where you're able to set a range for your liquidity. And the reason why it's a newer tech and a better tech is because it gives you a greater capital efficiency, meaning that like the tokens are being concentrated towards that price. For example, Ethereum to USDC, you could concentrate it to like, let's say $500 to $10,000 because it's not likely that these tokens are going to go to zero or like shoot to $10,000 overnight, right? So these tokens are being much more concentrated and being effectively used. And this leads to like lower fees and lower slippage for traders, which means that there's more volume running through as well because people are more likely to swap when there's not a lot of fees and slippage versus like going through a centralized exchange, right? And which in turns like give you more fees for liquidity providers as well. And so that's kind of like the background. Basically, there's 3-step process of deploying a liquidity pool. Typically, you want to start scanning for a pool, and depending on what you want to provide liquidity for, like there's different dApps out there that are best for like different types of pool. For example, if you're looking for like blue chip pools for like ETH, USDC, or ETH and Bitcoin, for example, then you might use something like Revert Finance. Or if you're looking for like lower cap tokens, you might use like DEX Screener or, Gecko Terminal. But let's keep it simple for today, right? And then after you scan, you want to simulate and then you go to deploy your position. So let's look at an example here. So one of my favorite ways to look for like a more established pool with blue chips on like EVM chain is using Revert Finance. If you click on the top positions here, you can see like all the networks it supports, right? Ethereum, Polygon, Arbitrum, Base, Optimism, BNB, and all the exchanges it supports right now. And what I want to do is typically I want to filter out the assets that I want to provide liquidity for example, ETH and USDC. I want to have the position age to be roughly 60 to 90 days to make sure that I get an accurate estimate of the APR. And then you want to take on no withdrawals and the in range only. So after I hit apply, you can see here their profit and loss in dollar terms, as well as their APR over time, right? And some of these positions have been in range for a very long time. You could see here 1,000 something days. That's like almost 4 years, right? And they're gaining like 20% APR on their capital. You could see a 75% ROI compared to just like, having their stable coin somewhere, right? So that's a pretty good return over 4 years, 75%, pretty decent for basically not doing much, right? So if we click on like one of these positions, you could click a random one, but I've already pulled up a position. You can see this is like 1,382 days. And you guys don't have to have like millions of dollars or like, $50,000 to yield farm with, right? Like this person, when they deposit it in July 23rd, 2021, the US dollar value is roughly 4,000 something dollars when they deposit it. And now you can see their capital depreciated a bit because Ethereum is trading like slightly below their entry price back in 2021. So you could see a negative divergence loss here. But what's interesting is that, they haven't done much at all. You can see they just deposited and they collected the fees once. And their total return is like 84% ROI on investment. So instead of just holding like whatever tokens you deposited, for example, they deposit like 2,000 USDC with 1 Ethereum, they're up 84% compared to just holding those tokens, right? So there's definitely profit there if you're looking to hold these tokens in the long run, right? And you could like kind of stalk the range they have. It's like if you set the same exact range here, roughly minimum 1,000, max 4,100, right? Then you could expect roughly a 24% APR over like a span of years, right? Using this ETH to USDC, 0.3% fee tier on Ethereum mainnet. Once you have like a pool you want to provide liquidity for, and this could be any asset, right? It could be wrapped Bitcoin to ETH or ETH to Sol we're going to go through like a simulation process. And this is Metrics Finance. It's one of the tools I use to simulate. And there's a more detailed like YouTube video on my channel to look at how I simulate pools. And you want to make sure you check that out if you want to like kind of dive deeper on this. But the basic part is, let's say I put in $10,000. I key in this min and max price that they had, right? And you can see the APR is slightly lower than what it was showing on Revert. Revert was like 20%, right? That's because the liquidity is pretty concentrated here. If I change it to custom price, you can see if I move the purple line to where there's like less liquidity concentration, my APR jumps to 18%. And then when it's like low concentration, then I'm earning like 77% APR. And when the market is very volatile, these tight ranges get knocked out of range, and people with wider ranges like me earn like a huge amount of fees during the short time. So once you know that, you want to figure out like the best and the worst case scenario, right? If you have the pro version of Metrics Finance, you can see like if it moves down, exits the bottom of my range, then I would be left with only 6,500 USDC, right? In terms of USDC, but my asset would be converted all to Ethereum. And if it pumps, then it's going to be converted to USDC, and I'm going to end up with $12,948. So this is why like the entry is also important for a liquidity pool position. If your goal is to make a USDC profit, for example, then you entering this pool now, and if Ethereum trades above the current price, then you're always going to be in a USDC profit. Similarly, if I have a SOL to Ethereum LP and I entered at a good price, then as long as SOL is trading above that ETH price that I entered on, then I'm going to be in Ethereum profit, right? So that's a simple framework to kind of like think through your entry and your exit, not even counting the fees, right? And if I click on the simulate position performance here, and I key in Ethereum equals to, let's say Ethereum pumps to $4,000, you can compare like the value versus holding versus the value in the LP, right? And you can see there's quite a huge difference here in terms of like holding and the LP, because as Ethereum pumps, right, whatever Ethereum you have in the pool, in this case, it's like 57% of Ethereum and 42% of USDC is slowly being converted to USDC, right, at the price above your entry. So now at $4,000, I only have like 2 or 3% worth of Ethereum left. And then compared to holding, I would be up like $4,000 in terms of holding, right? And you can see I would need like more than 1,500 days to beat just holding. So this is definitely not a pool you want to be in if your goal is to accumulate more crypto and not miss out on the pump, right? But I'm just showing you guys this as an example because like it's easier to understand, right? Ethereum and USDC. So that's the process. And if you decide you want to hop in to this pool, basically you want to go to Uniswap and put in whatever assets that's showing here, right? The ratio that's showing here. So that's a quick like overview of actually scanning and simulating and deploying. For each process, there's a lot of different ways you could do it. And some ways is better for like, lower cap tokens or crypto to crypto pools. If you're running like a leverage setup, then like it could be much more complicated, right? So let's see. So there's pros and cons of concentrated liquidity pool you're farming, but this is not like an exhaustive list, right? There's a lot more to dive into. The advantage is versus like just trading, there's cash flow, right? If you're in between trades, especially if it's like a longer term project that you believe in. For example, a lot of us here believe in Pixel. It could take years for your thesis to play out, right? And if you don't provide liquidity and you don't yield farm, then during these years, you're basically making like zero income, right? Assuming you don't swing trade or do anything like that. And the nice thing again is the cash flow. And because you have cash flow, it lowers your cost basis over time. For example, like with Pixel, I've lowered quite a lot of my cost basis because I'm basically accumulating a lot of Pixel and Ethereum for free as long as my pool stays in range and people are trading those tokens. And if I'm in the pool, for example, for the next 5 to 10 years, my cost basis becomes lower and lower. And if I take profits on that, it could be basically a free ride, right? Just like if you're trading NFTs, if those NFTs like 2x, for example, and then you sell one of them, then basically your cost basis becomes zero, right? And you could basically yield farm for free, whatever you accumulate over time. And it's low time commitment if you guys run like my strategy, because I run a wider range and a longer term approach to liquidity pools. Like a lot of people, there are some channel out there that run like really tight ranges and like they flash you like, 100, 300% APR, 1,000% APR. But these pools often like get out of range a lot. And then like when you rebalance them, sometimes you lose capital, especially if the token retraces, right? So there's much more like nuance to this, but it's lower time commitment and there's more room for error, right? Because when I enter into a liquidity pool, for example, and it dips below my entry, let me pull up an example. For example, Arrow and ETH here that I'm in. The orange lines are my upper and lower range. And then the green line is my entry. It's trading roughly at my entry right now. And if you like basically refresh this profit and loss page, you can see when it's below my entry, then I have like a negative divergence loss, right? But because I've been earning fees over time, it's trading up, near my entry, I'm actually up roughly 6 to 7% on my investment. So that's not bad at all. And when I say like a larger room for error, that's because like when the token is trading below my entry, I could choose if I want more exposure to this pair, for example, to basically compound more of my fees, either from this particular pool or from like other pools. And what's that going to do is it's going to drag down my entry, right? Similar to how you like DCA into like tokens you're bullish on, it's going to drag down your entry. And when it rebounds, then you're going to be in profit much easier. So there's more room for error, but yield farming does come with its own cons, right? It takes patience, but I would argue that it takes less patience than like, if you're cycle trading or even if you're swing trading, like higher time frames, like daily and weekly chart, because you're earning fees in the meantime. But you do need some patience, right? Especially if you're running a wider range strategy. It's not going to make you like hundreds of dollars overnight if you only have a small portfolio, right? It does take like experience and knowledge. If you're not properly equipped and you put a lot of like capital on the line, you could lose a lot of money. And I mean, I've taken so much time to learn this, right? And hopefully it takes you guys less time to learn because I've, basically distilled all of the useful information and give it to you, right? And I've lost a lot of money providing liquidity too. And I've been, net positive, but it's still painful to like make these mistakes, right? And then another con is it does need capital, right? You can't like make $10,000 per month from yield farming with like $100. It doesn't make sense, right? If we go back to our like freedom formula here, you do need capital. For example, if I want to earn 10% APR and then I want to cover my $30,000 of annual expense, then I need to save up $300,000 and kind of like build my portfolio through other means, right? Through trading or active income to be able to save that, $300,000. And so that's pretty long so far, but I wanted to give you a list of big mistakes for people that have been yield farming already, that are dabbling or struggling. And like 7 of the biggest mistakes I see a lot of people make when it comes to yield farming. And I I'll explain each one and hopefully it will make sense. So the first one is thinking short term. If you're like providing liquidity for very low cap tokens that are new, they're typically very high risk. And sometimes I do that similar to like the basis for everyone token. I had a thesis behind that, but then I was wrong, right? And I went a little bit too heavy on that. And I'm still holding on to it and hopefully it turns around. But if you're thinking short term and like you're putting a bulk of your portfolio in like these really risky, like sub 100 million market cap tokens, then a lot of times you might be burned and lose like 90% of your portfolio, right? And the number two is setting ranges too tight. If you're a good trader, you could make it work in certain contexts. Or if you're like doing a leverage yield farming strategy that's a little bit more complex to set up. Like if I'm lending out my ETH, for example, and I want to be bullish on Ethereum, I could borrow USDC and then yield farm with like an Ethereum to USDC pool with a slightly, tighter range, right? But typically for beginners, you want to set your ranges wider. I typically look at the weekly chart to set my ranges. If we hop back to that arrow to ETH pool here, you can see I'm on the weekly chart, right? And I'm capturing at least like 6 to 12 months of price action because the longer you stay in range, the less you have to worry about impermanent loss and like the more fees you could accrue over time versus like people that are chasing ranges. And I've seen people with like years of experience in yield farming and they sell like courses and stuff, and their strategy is like they set a very tight range, they chase the ranges, and then when I stock their portfolio, they're actually at a net loss because of that, right? So it doesn't make sense to have tight ranges if you want to make this a more sustainable thing long run.
I'm very,
Um,
not gonna lie to
yeah.
you, I'm very susceptible to the first step, to those mistakes. Like I would argue that the main reason when you ask where we are, I said gambling because I cannot for the life of me stop doing this. Like I'm very prone to go into like highly volatile assets and be like, well, I do like this asset. I'm bullish long term. I'm just gonna LP the fuck out of it with giga high
Yeah.
risk and get like 300% APR and hope the fees save me in case it goes wrong.
Yeah, I mean, like it definitely makes sense for a portion of your portfolio, right? But you definitely cannot like scale that up to like 50 to like 75% of your portfolio, right?
Definitely. And I know I'm interrupting the flow, but I'll stop.
Yeah.
I'll make it quick. But I think the most valuable thing is like the low risk part because I tweeted about it yesterday. Like I'm talking with friends IRL, and they got capital and they don't really know what to do with it. So if we could have like solid low risk ways to get that 15%, like even 10%, dude, like 10% with low risk is a lot. Like it's not a joke. And then in many cases, like you have an airdrop farm opportunity on top of that percentage, which is nuts by itself. So yeah, I think that the juice is the low risk part. The high risk is like, yeah, it's like degening with a hedge.
Yeah, and what the is talking about this 4 trillion percent APYs. Like in the past, there were many opportunities to get APYs high enough that the platform was not showing you number, it just showed you a fire, and just the whole pool is gonna be so thin, it's gonna crash 20 minutes.
Yeah.
So big API really resets.
Yeah, typically like risk and return is like tied together, right? Higher risk, typically means like higher return. And if you're gaining like, 300, 500% APR, then you're probably putting on a lot of risk, right? And that's fine for like, if you manage it, right? But if you let it go out of control, it could definitely kill your portfolio.
For sure. Like I've used
Yeah.
this example in Purple in the past, but for example, like Hardcoin is a place where I keep getting backed because of that. It's high volume. I track the coin and I keep being right, but it's like over risking is like it ends up ruining my own position. But yeah, we'll let you continue.
Yep. Like you can make a lot of money if you're right, but if you're wrong, you could also lose a lot of money, right? So it depends on how you manage risk. And, typically for beginners, you want to like stick with the lower risk strategies first, especially if you're wrong a lot of times more than like you're right. And then the third mistake that kind of ties into that is if you're picking bad assets, right? Like for example, that base is for everyone token. Maybe it'll turn around, if the Jesse from base actually like pushes this token. But I was surprised like how weak it traded. But anyway, like the APR was very high for those tokens. And obviously I'm in a loss right now. So it didn't cover the asset depreciation. So I would argue that the most important thing is you want to make sure you're providing liquidity for assets that are likely to appreciate over time, right? You don't want to be like blinded by the high APR and providing liquidity for assets that are going to like bleed out over time, especially if you're like looking at the Ethereum or Bitcoin chart of that asset. If it keeps bleeding out, you're going to lose money, right? And then the fourth mistake is not reinvesting some of the fees or all of the fees, depending on your goals. Like if you're building your portfolio from scratch and you still want to grow it, then it makes sense to like compound your investment, like the majority of it or like all of it, right? Especially if you do make wrong decisions and like you didn't get the perfect entry. Sometimes like the LP value of your pools are going to like, fluctuate between like appreciation and depreciation, right? So if you're constantly like using the fees, for example, to like party or like just burn it away, gambling on meme coins, then you're gonna basically like decrease the value of your portfolio over time. The fifth is you're not diversifying enough, right? Some people make the mistake of like, were you gonna say something?
Yeah. Sorry. On not investing fees, I haven't LP'd in a long time, but I remember Beefy, like auto compounding. Are you using any auto compounding platforms right now, or are you doing it manually?
I do all mine manually. And the reason why is like, I don't really want to compound my investment a lot of times. If it's like trading above my entry, for example, in the example of Bonk and ETH, I could pull up the chart real quick, but basically it's trading above my entry. And when it's doing that, basically if I want to de-risk, then I want to like be selling my fees, right? And then if it's like trading below my entry, that's the best time to compound your fees actually, is because, when you do that, it basically drags down your average, right? Versus if you use Beefy and the price keeps trending up and you didn't like basically de-risk your portfolio at all and the token retraces, then you would have been better off just like managing it manually, right? Like you could see the green line is my entry here on Bonk and ETH, and the orange lines are like the wide ranges. Like at this point, if I am already like heavily allocated to this pool, then it doesn't make sense as well to compound, right?
Yeah, I get that. Thank you.
Yep, no problem. Let's look at the next con here, or the next mistake. So not diversifying enough, meaning that if you put like, let's say 100% of your LP on one chain and on like one pair, right? For example, even stuff like if you're doing like Ethereum to Bitcoin, usually it makes more sense to like diversify your investment because like one token might not be doing well, right? For example, during the past like 2 or 3 years here, Ethereum bled hard against Bitcoin, right? And if you put all of your capital in there, for example, and you're bullish on Bitcoin, then that's too bad, right? Because all of your tokens in the pool probably got converted all into Ethereum. And so you got to diversify your investment. I typically aim for at least 5 to 10 pools. And it's not too much to manage if you stick with like the weekly charts to set your ranges versus like, sticking with the daily or the 4-hour chart to like squeeze the ranges, right? And the sixth is again, not taking profits. When the profit opportunity comes, even if I'm suffering like more impermanent loss compared to holding, I'm still down a little bit, but I'm net profitable on my investment. A lot of times, like when the profit opportunity comes, I might exit the pool, right? It makes sense to take profit. And like the example I just showed you guys, right? The Bonk and ETH. If I want to de-risk, then I'm heavily selling my fees when it's trading above my entry, right? And the seventh mistake is tracking the wrong metrics. if you're optimizing for crypto accumulation, for example, then you want to track your assets in crypto terms, right? Whether it's like Solana, Bitcoin, Ethereum. Right now, I'm following like a more Ethereum accumulation strategy, but I'm also like DCAing Bitcoin with the fees that I take profit on to balance out my portfolio versus like, tracking my portfolio in US dollar terms, especially if we haven't like resumed like a upward trend that's like a sustained, uptrend, right? Then it doesn't make sense to track your performance based on the US dollar terms because one day Ethereum could be trading at $2,000. The next day it could be trading at like $1,700, right? It doesn't make sense to be tracking that way. And it depends on which pools you use. For example, if my goal is to make US dollar profit and I'm LPing ETH to USDC, then it might make sense for me to track my profit and loss in US dollar terms for that particular pool, right? So that's also very important. I think we're almost done here, but basically there are like three main things you need to be a successful yield farmer. The first one is fundamental analysis. You got to know like which asset to pick, right? You got to know how to research these tokens. And then you got to know some technical analysis, right? And I'm sure like GVan and Moondweller and the guys in here could help you guys a lot with that. And then the liquidity pool specific knowledge. And this is where I come in most of the time is like, for example, what is liquidity concentration, right? And why do you want to run like a wider range versus a tighter range strategy? And then, for example, if you want to run a leverage setup, how would you go about doing that, right? So these are all more like liquidity pool specific knowledge. And there's like more knowledge overlaps too between like yield farming, investing, and trading. And, ideally you want to try to master all three, right? If you have time, you maybe like start with one or two, and then eventually all three is going to overlap and it's going to make you more money in the long run. So I hope that kind of like move you towards like the next stage on this cone here between like unaware, aware, dabbling. And, a lot of my videos on my YouTube channel and what I post on X is designed to like basically give you as much value as possible. And be sure to follow me basically on X or on YouTube, and also Soluminati. That's the NFT project I'm working on with a few seals on Monad, and DeFi is going to be a big part of that NFT community, right? And my YouTube handle is the same as my X handle, just Richard N and then HSU. But that's pretty much it for this presentation. If you guys have questions, I'll be happy to answer them right now.
Richard, fantastic, dude. Fantastic presentation. First of all, appreciate you. Loved it. I think chat loved it as well. Like, chat is going crazy. I have dropped the form. You guys should go fill it in. We're going to be giving out 5 Illuminati NFTs to people who fill in the form. We'll see how we pick them, but I'll keep you guys updated. For now, make sure you fill in the form. I'll keep spamming it. If you guys got any questions, feel free to drop them. I don't want to keep Richard for too long. I know it's like fast midnight for him at this point. Go check out his YouTube channel. I linked it as well. I noticed we got him a few subscriptions since the workshop started, but we can do better. Yeah, I'll stop talking now. Oh no, actually, I got a question for you. Do you usually do more linear or concentrated LPs? Like, do you just spread unevenly, or do you look for more concentrated liquidity around the center or the edges? Have you played around with both? Any tips on that, basically?
You mean like one-sided or like a V2 pool?
I'm talking about when you deposit like both ETH and let's even use this. Do you spread linearly or do you not linearly? Or something else that works?
I typically like pair 2 assets because like sometimes I'm not like 100% sure that like a token is going to like pump or dump, right? So I give like a buffer room when I set like the range. For example, with the Bonk and ETH pool, let me show you guys the chart. Like when I entered, it's actually at an area of support, right? And usually that's a good area to enter. But I also have like a wide buffer on the downside. And maybe like I made less gain than if I had like tighter range here, but it's also lower risk if I'm running it this way, right?
The reason I'm asking is that sometimes like something I like to do is like not spread the liquidity evenly across the range. I like, for example, to add more liquidity on the upper bound. So it's like so it sells higher and I get a little bit more upside in case the token pumps, for example.
Yeah, that makes sense. Like I think I did that with like most of the pools. I'm pretty sure for like Bonk too. But yeah, it depends on like the market condition. If you're bullish, then definitely you want to like move that bottom range to be closer here. And then you're going to get more upside, right? But yeah, that's a nice way to look at it. Yeah.
I think like here's how I see LP provision myself, and tell me if you think it's a good way to look at it, right? So usually I try to pick a decent entry, and I'm like, if I wanted to start DCAing into this coin, I would do it like on this level, and then I look, downside and be like, okay, how low would I be willing to continue DCAing in without something fundamentally breaking, right? So I'll put the USDC in that range a little bit, so it acts like as a DCA down, and then I look at the upper range as a way to TP out, and then I'll treat the fees as a way to hedge against something going wrong and taking out some of the upside potential, like how much money can I make goes down, but how much money I can lose also goes down in a sense. Does it make sense?
Yeah. It makes sense to do that for sure. Like if you don't want to buy at that price, like for example, a token just like 10x, right? Then you definitely don't want to provide liquidity for that token. When you first enter, it's like when you're comfortable to buy and basically like also DCA and like you talked about if it retraces a little bit. But the reason why you entered in the first place is because you believe that it's going to rise above your entry, right? Maybe not like tomorrow, but like at least, 3 to 6 months or like 6 to 12 months from now, right? Yeah. And then, like you said, if your goal is to de-risk, then definitely you want to be like claiming your fees and then selling it to, in your case, if you're like doing, for example, Farcoin to USDC, then you want to like sell that Farcoin for USDC to de-risk, right? Yeah. That makes sense. Yeah.
I was gonna ask you about the fees exactly. Like, how often do you usually claim fees, and how do you guess it changes depending on what you want? But how often do you claim fees? Do you have a specific strategy around optimizing that, or is it more like see how the coin performs, see how you feel about the overall market type of thing?
So with the fees, yeah, it depends on your market outlook, right? If you're running multiple pools and like you're still bullish on like crypto, for example, in the next 6 to 12 months, which I am, then I'm not going to be like stapling up most of my fees, right? I could sell it into like something safer, like Bitcoin. For example, I typically harvest once a month. At the end of the month, I sold like Bonk, for example, some Arrow, and some Solana to Bitcoin just to like de-risk my portfolio, roughly like $700 worth of Bitcoin that I basically got for free from yield farming, right? And if you find like a pool you're bullish on, for example, if I'm still bullish on Bonk and ETH and it has retraced quite a bit, then it's a great time for you to like compound some of those fees. You either de-risk or harvest it earlier, right? Or whatever other fees you harvested that month. And I think Trader Ada has a question. Is it possible to provide yield in a bull market versus a ranging market? So the worst market to basically stay in an LP is like during a crash when the tokens are like rapidly depreciating in value, right? Because your LP is going to like go down a lot. That's how a lot of people got wrecked in like February, especially if you're running tight ranges and you're not that bullish on the token, right? The token, like for example, if I'm providing liquidity for ETH and Bonk here, and I started here in December at this high point, I entered up here, right? If it's bleeding against Ethereum, then the Ethereum value of this pool is going to like drop by quite a lot. And if I'm bullish on Ethereum more than Bonk, then that would be a painful hold, right? So on a downtrend, it's not very profitable. But at the same time, if you believe that the token is going to bounce back in price, either in crypto terms or in US dollar terms, then it's still fine to provide liquidity for those tokens. But the best market is either a ranging market or actually a bull market. For ranging markets, the price is moving sideways, right? So there's much less impermanent loss. Basically, when there's a lot of price movement, there's more impermanent loss, right? And during a bull market, your US dollar and crypto value typically would both go up over time because like alts, smaller cap alts tend to like outperform larger cap alts like Ethereum or Solana when like the market condition is really good, right? So you're going to be at a net Ethereum profit or Solana profit much easier in a bull market. But you gotta make sure you're taking profits on the way up, right? And I think someone asked about risk earlier, but basically if you avoid the mistakes I showed in the presentation, then you're at a much lower risk, right?
I think
Yeah, I have a question. Sorry. Like I saw that most of your positions were like beating the impermanent loss, but I remember like on UniV2, like most people were basically losing for impermanent loss. Is it like you are choosing the right pools in order to beat impermanent loss, or you feel like with this like ranging style LP farming, most pools actually beat impermanent loss nowadays?
So there's actually a great video on my channel on like impermanent loss, for example, how to beat impermanent loss here, 5 proven strategies to beat impermanent loss. But the main reason why like most people don't beat impermanent loss is because they're running like very tight ranges. The tighter your range, the higher the impermanent loss, right? And the tighter the range, the likelier that you're going to be knocked out of range. And when you're knocked out of range, you have to realize those impermanent loss by rebalancing, right? And then it becomes like a negative cycle, right? For example, the price dumps, you're rebalancing down there, and then price pumps up again. You miss the upside, you rebalance on the top price, and then when it retraces again, you're actually, getting all of the downside without any of the upside, right? So it's actually pretty bad strategy to be like rebalancing all the time with very tight ranges. So if you have like sufficiently wider ranges and the asset is not, bleeding out over time against like the quote token you're providing liquidity for, in my case, Ethereum, right? And then you stay in range for a very long time, then it's very likely that you're going to be able to beat impermanent loss.
Makes sense. Thank you.
Yeah, no problem.
A really good question in the chat from Pins Croco.
Yeah, great question. So sometimes I might like realize a loss if I find like another opportunity, but I want to make sure it's not just like a decision that's made out of fear, right? And like I'm not just chasing like the next shiny object, right? Some people like always think like there's a grass that's greener on the other side, but then like when you hop into the pool, you find out, okay, maybe the APR is not as high as I thought, or the airdrop ended up not being as much as I thought, right? So typically, like for solid assets, I typically don't like cut my losses because I started out with like the assets I'm comfortable with and with only the capital that I'm willing to lose. And I would rather like sell into strength than like cut my losses, right? And typically, if these assets you're providing that you're bullish on, they're going to like bounce back, like between underperformance and outperformance, right? If we look at the arrow to ETH chart, you can see when I entered back in like, I think February, it was at like 0.000344. It retraced all the way to like 0.0002, which is like a pretty huge drop, like I think 30-40% drop. And then now it's trading above my entry again. If I like basically exit this position down here for a loss, I would not be in a profit right now, right? So I hope that kind of answers your question.
Don't go degen with your picks, so you don't have to feel horrible when you're at the end.
Yeah.
And if I can add something on arbitraging, it doesn't have to do with LPing, but generally, if you think about arbitraging, you're gonna find the best arbitrage options are in new platforms. So there is always smart contract risk there. You really go down that rabbit hole.
I was gonna ask the same. Like, how do you manage safety in that regard? Because yes, like you're probably gonna get better yield and better opportunities in your platforms, but obviously that comes with risk.
Yeah, I mean, you definitely want to like use an amount you're comfortable to lose, right? If you could stomach like a 5% loss on your portfolio, then you could use, for example, 5% of your portfolio to yield farm. For example, I think Hyperliquid would probably have a juicy airdrop if you go to like Hyper EVM and you LP stuff like Bitcoin to, I think it's called like unit Bitcoin to Hype or like unit Ethereum to Hype, depending on which assets you already hold, then you could be earning points for airdrop, right? But you don't know what's going to happen and you want to always diversify like across different dexes, different platforms, have some in like cold storage, right? You don't want to like go all in liquidity pool either because like at the end of the day, there's still like smart contract risks, right? Even platforms like Uniswap. So
Even
yeah.
Uniswap, like what can go wrong in Uniswap? LP specific hacks is this a thing?
I mean, it's pretty safe so far, but I'm not like a tech expert, right? For example, they release a V4 pool, but honestly, I didn't dive deeper into it. Like it's a new set of like, I guess, smart contracts. They added like new hooks and there's always new risks when there's like new protocols and stuff, right? Especially for like newer chains and like smaller DEXs.
Yeah, the Hyperliquid example is a very good one. Like great opportunity, but unproven, and you are taking risk by default.
I think diversification is the key here, dude. Like,
Yeah, for sure. Like for smaller chains, I personally wouldn't put more than like 5 to 10% of my personal portfolio, but it could be different for you guys.
I agree. I usually don't even go above 5% with that type of thing. Like I'm insanely cautious with this type of thing because it doesn't make sense to me to look for passive opportunities with risk. Like it just doesn't. Like farming,
Yeah.
like risking like a big chunk of my portfolio to get points specifically is like I don't think
Yeah.
it's very smart.
And it's also hard to like quantify how much airdrop you're going to get versus like, for example, I provide liquidity for these tokens. I already know like, okay, what's the rough APR I could get, right?
Exactly.
And I think Will Season asks, do I look at fundamentals to LP or exit? Well, fundamentals is definitely a key point as well. So you kind of want to look at both, right? Because a lot of traders and investors look at both and like both kind of like determines the actual price movement of the project. Because at the end of the day, like technical analysis is good. It works because people use it. But like, for example, if everybody is selling at like resistances, then it's highly likely that resistance is going to turn into a resistance point, right? But the problem with technical analysis is it could be affected by fundamentals. For example, like if next week Trump decides to like, cancel all the tariffs and then do a bunch of stuff, like the Fed decides to like cut rate and print money, then obviously like assets might go up in price over the next 6 to 12 months, right? So the fundamentals definitely matter. That's why like Donald Trump, like winning the election basically brought us that earlier pump, like early last year and beginning of this year, right? A lot of people basically front ran the news and then it became like a sell the news event when he actually like went into the office and basically started with the terrorist thing, right? So fundamentals do matter, like stuff like tokenomics. But typically if the chart like looks nasty and like it's just simply bleeding out against Ethereum, especially when Ethereum has been pretty weak this cycle, then I'm probably not even going to spend the time to research it, right? So I typically start with the chart.
Yeah, I mean, for me, the basis of it is like finding a good entry. You gotta start with that, right? You gotta be bullish fundamentally. I think that's a very key point. Like you gotta be bullish fundamentally in whatever you're holding, because especially because it's a long-term thing, like conviction and having a very clear thesis, I feel helps massively. And I was talking about with someone, I cannot remember for the life of me who it was, and they were telling me that when they take a trade, and I think this applies perfectly on LPing, is like they write down exactly when they bought it, why they bought it, why they believe in it, what would it take for them to change their mind. So with LPing, like you have to have conviction long term, right? Otherwise, you're gonna be flip flopping and rebalancing, and you're gonna be doing stuff and realizing losses that you shouldn't. So yeah, conviction and fundamentally believing in the asset has to be like a big part of taking a position.
Yeah, for sure. Like that's very important. Like that's why like it's important also once you like, okay, kind of look at the different LPs, you do more research on the token, right? Because
Yeah.
ultimately your conviction is going to be backed up by like actual fundamentals, right?
Yeah.
And yeah.
Just one more question. Like, so you prefer to like enter a position in support and have the upper bound of the range on the top side of the range, or do you prefer to enter in the middle of the range so you can have like a tighter, concentrated pool, but you are actually entering in a worse like part of the range? Do you understand the question?
Yeah. So I try my best to avoid entering like resistance areas. I might still try to like hop on like a token that's in the middle of the range if I believe that it's going to like pump higher, or if it's like showing signs of reversal, right? If we look at like Aerodrome and ETH, for example, when I entered, it's actually like I think closing above the 20-day EMA or something, but then it got rejected and then trended down, right? So definitely not the best entry. I tried to like enter, but like it was at like a trend line support, but that support broke down to like this horizontal support line, right? And I've found over time, like basically horizontal support lines are like the best entry point, I would say, compared to trend lines, because like most people draw like trend lines differently. You could draw like a bunch of different trend lines, right? But like horizontal support and resistance is pretty clear. Like, okay, this area is a support, this area is a resistance. And I did just that with like Bonk and ETH, right? I saw that it's trading near the support area. And if I just drew like a horizontal line across, you could see like 80-90% of the time it would be trading above this price. So I'm happy to buy this asset at this price, right? Like if you're not happy with your entry, then you shouldn't enter that pool at that time. You should add it to your watch list and maybe like decide whether or not you want to enter later on when it becomes cheaper, right? Because if I'm LPing like Bonk and ETH, for example, even with like higher volume, if I enter at like areas of resistance, then it becomes a much riskier pool, unless my plan is to basically like DCA into it and then like drag down my entry, like I explained earlier, right? Either using the fees from the same pool or the fees from the other pools to basically keep dragging down my entry.
Because what I was saying is that if you enter in the middle of the range, you actually can get like half of the concentrated liquidity can be like on a tighter range, like a range with like half because you are entering in the middle. You actually gain a lot more yield, but since you are entering in a worse spot.
Yeah, I mean, I guess the tighter the range, like the more yield you're going to get, but the likelier it is you're going to be knocked out of range, right?
Yep.
Yeah. So it depends on your strategy, but I run I guess I would call a pretty wide range, but still not a full range strategy. So yeah.
Okay. Thank you.
Yeah.
Awesome. Good. I think we should let you go to bed. It's 6 where you're at.
Yeah.
Let me share the links one more time. All right. Guys, I need you to go check out Richard's YouTube account. And I need you to fill in this form on my behalf. Dude, I feel like I've been LPing for some time, but You gave me a lot of fucking things to think about and start. Like, the one thing that hit me the most is like my process is so shithead. Like, you're so much more civilized in the way you do things, and it makes sense. And it's like I know for a fact I'm losing a lot. I'm just bleeding money because I'm dumb and I'm not doing things properly, and I'm doing them more, chaos. So huge thank you, dude. Insanely valuable stuff. We really appreciate you. I cannot wait to see what you guys do with Illuminati and where you take things forward. I know you guys you got a lot of plans. Very excited to see you deliver on them. Also, your YouTube account Moon Dweller has been talking about it. Like, I know Moon Dweller IRL, right? He's been talking about the IRL to me for some time now. He's very excited about it. I've been checking it out. Like, I think I was one of your first subscribers. So, dude, very excited to see you grow. Very excited to see you. Very excited to see how much you've grown since we first met. Let me put it like this. And a huge thank you for today because it was spectacular. So yeah, appreciate you, dude.
Yeah, thank you
Yeah.
for having me. And I love doing these events with you guys. We could do another event in the future too, if you guys want. We could dive deeper into a particular topic as well.
Okay, absolutely.
Yeah.
All right, guys. Any last words?
Yeah,
Okay,
thank
okay.
you, thank you a lot. Thank you a lot. One thing I would like to add as someone who I don't really LP, but looking at all the videos and the liquidity provider perspective is really informative, even if you trade. It's really
Yep.
informative.
Yep.
And it is very psychologically beneficial to know that some people work like that.
Yes, because you understand how the back end works. Like, trading becomes like you start looking at it a little bit differently after you realize how the other side works, right? Diego?
Yeah.
No, dude. I was gonna say just thank you. It was amazing. Like I do LP and I love this. Like I mean, I do LP like in a more decent type, and I still do it good and I do well on that. But like going with series part of my portfolio, I've never done that. Like I just use a small, like really small part, maybe 2% or something, or maybe less even, and just go like very deep about it and I do well, and I love this, but I've never thought about LP being like a big part of my portfolio. Just I don't know why, and I'm going to consider like this for real.
Yeah, it could be a game changer depending on how big your portfolio is, right? Like if you have a 6 figures portfolio, for example, like earning 50% APR per year, that's a
Yeah, it's
game
crazy.
changer for most people,
Yeah,
right?
this is crazy, bro. Like comparing it to other yields around, like dude, this is crazy.
Yeah, it's definitely crazy. Yeah.
Thank you.
That's exactly what
Yeah.
hit me when I saw the slides the first time. I was like, huh, okay, we gotta get more serious.
Yeah, exactly, dude. Like this is the right way to do it. Like, yeah, we all love gambling, but this is the right way to do it.
Yeah, for sure. Yeah.
I want to get us talking about portfolio management at some point. Anyways, okay, let's wrap it because I want to let Richard its weight. We'll be in touch and with this stuff with Richard 100%.
I will bring you back, bro.
All right. Sounds good, guys.
Thank you, Richard.
Thanks for having
Thank
me.
you, guys.
I'll catch you
Dude,
guys
congrats
on the next one.
Illuminati. Yeah.
Thank you. Yeah, it's going pretty well.
Oh man,
Let's
okay.
go, mate.
Let's go. By the way, on the slide side, we'll update you guys. I gotta chat with Richard and see what's the best way for us to release. But we'll release the session and we'll keep you updated. Someone asked for the slides, but yeah, we'll update you. I'll talk with Richard tomorrow. Go get some sleep first, bro.
All right. So thank you guys.
All right.
Oh,
Thank you, man.
Richard.
Bye.
Thank you.